So how does tax work in Australia? In this video, you're going to learn the fundamentals of Australian investment tax. I'm going to show you how to calculate both capital gains and taxable investment income and cover some of the common mistakes that catches out investors at tax time. By the end of this video, you'll know everything you need to become a tax literate investor in Australia. And I'll also share with you a powerful new tool I've built to automate this complex and often stressful process. Now, all of this, of course, is not financial advice or tax advice. It is purely just information to help you become a better investor. Let's get started. So what is capital gains tax, or CGT? Well, first let's look at what is a capital gain. A capital gain is when you sell a stock for more than what you paid for it. So if you bought a stock for $1,000 and then later sold it for $1,500, congratulations, you've made a $500 capital gain. So when is CGT applicable? This is when you have a capital gains tax event and have made a capital gain. The most common time a CGT event happens is when you sell a trade. There's plenty of other events that cause it if you're transferring shares from your name to somebody else's name. Certain mergers and acquisitions, that's a CGT event. If you've ever held a stock that got bought out by another company, that's often a CGT event as well. But there are cases when CGT is not applicable. For example, if you've made a capital loss, you do not pay tax on that. And in fact, you can use that capital loss later to offset some of your capital gains. So how do you calculate a capital gain? The basic explanation is you subtract the cost base from the final sale value, and that results in what your capital gain or loss figure is going to be. The cost base is what you originally paid for the shares. So if you bought 500 shares at $2 each, you've got an $1,000 cost base on that holding. So if your cost base is $1,000 and you sell those shares for $1,500, you take the $1,500 sale value minus $1,000 for the cost base, and that leaves you with a $500 capital gain. So that's just a simple example of calculating a capital gain, but obviously in the real world it gets a lot more complex than that. For example, what if you only partially sell the stock that you hold? Also, what if you've bought into that stock multiple times and then go and sell some of it? These are really common events that happen to investors when calculating CGT. Check out some of the videos that I've linked in the description on the different CGT strategies you can use for calculating capital gains. Another important area of CGT in Australia is the 50% discount you get for holding shares for longer than 12 months. For example, if you made an $1,000 capital gain but had owned those shares for more than a year, that $1,000 capital gain becomes a $500 capital gain. Whereas if you bought some shares and sold them 3 months later, that $1,000 capital gain would not be applicable for the discount and it would remain at $1,000. So the Australian tax system is there to incentivize you to hold your shares for a long period of time, rather than doing frequent day trading type activities. So how are capital gains taxed? Once you've calculated your net capital gain across all of your different investments, that net capital gain gets added on to your total taxable income for the year. So essentially, if you made $100,000 in the year from your normal job and then made a $2,000 capital gain, your total taxable income for the year is essentially $102,000. Your net capital gain is all of your gains minus your losses, and then with the 50% discount factored in. So how do you report capital gains and losses on your tax return? So let's put all the information we've just learned into a few steps. Step 1. Calculate all of the capital gains and losses across all of your investments. Step 2 is split those capital gains out into your long-term capital gains. So that's where you've owned those shares for more than 12 months. And then split it into your short-term capital gains. So they're all the gains on shares that you didn't own for more than 12 months. Step 3 is subtract your losses from all the short-term capital gains first. Then subtract the remaining losses from the long-term capital gains. We do it in that order because the long-term capital gains qualify for the 50% discount. So we want to get rid of all the highest tax burdened shares first. Step 4 is apply the CGT discount to all of the remaining long-term capital gains. And that's it. You've arrived at your net capital gain or loss figure. This will be the figure you use in your tax return. So now we've covered the first major part of investment taxes, being capital gains tax. Let's jump into the second big component, which is your taxable investment income. This is the tax you pay on all the investment income you derive from owning shares, things like dividends and distributions. So first, what are dividends? Dividends are payments made by a company to its shareholders, usually from its profits. But there are different types of dividends, and it's really important to understand the differences between them for tax purposes. Firstly, we have fully franked dividends. These are dividends where the company has already paid tax on the profits that those dividends are paid from. Because of this, shareholders receive a franking credit, which they can use to offset their own tax liability. And next, we've got unfranked dividends. These are dividends paid out of the profits by a company where they haven't paid the tax. Because of this, there's no franking credits attached with these, so you'll have to pay the tax on the full amount that you receive. So understanding the difference between franked and unfranked dividends can make a huge difference on your personal taxable position. So how do we report investment income at tax time? Let's break it down into a few steps. So step one is gather all the dividends you receive from Australian listed companies. And then you're going to want to calculate the unfranked total, the franked total, and the franking credits total. Step two is gather all the distributions that you received from Australian ETFs. And again, on those, you're going to want to calculate unfranked total, franked total, and franking credits total. Step three is get all the dividends you receive from foreign investments. So that's things like any US shares that you own that you've got dividends on. And you want to calculate the total dividend received and any foreign withholding tax that you've paid on that as well. And that's it. You now have all the information you're going to need to file your tax return at tax time. Some common mistakes to avoid. The first one is failing to report all the different capital gains tax events that happen throughout the year. It's really important to keep track of what you've sold and what counts as a CGT event so that you can report it accurately to the ATO. But one of the biggest mistakes investors make is not keeping records of what they're filing with the ATO. It's all well and good that you sold some shares and you filed it, but if in several years' time you get audited by the ATO, you need to prove exactly how you arrived at the totals that you did. That's what's really important, to keep a lot of record when dealing with investments. Now, I hear some of you saying, but Navar, that sounds pretty complicated still, and some of it can be. So that is exactly why I built Navexa, which automates a lot of this complex process for you and does all the record keeping so you don't have to worry about it. Let's jump in and take a look what that looks like. Navexa supports importing your data from all the major Australian brokers like CommSec, Selfwealth, Pearler, Stake. You can easily go into here, find the instructions and import your data. Then we give you a really nice portfolio dashboard to see performance like you've never seen it before. Things like your capital gains, income return, so how your dividends are affecting performance, currency gain or loss, so if you're invested in US shares, for example, you can see how the exchange rate's impacting your performance. Then we wrap that all up to give you a nice total return. We then factor in time by annualizing it, and we give you a very accurate return figure. Underneath here, you can see we can benchmark our performance against anything we like. So in this case, an ASX 200 ETF, and you can see over time how our green portfolio is comparing against the benchmark. Then under here is a breakdown of all the individual holdings in the portfolio, and you can see their capital gains, their income return, total return, and whatever else you would like to see. From a tax point of view, we've got this awesome tax overview page. So what that allows you to do is log in at any time during the year and see what your current CGT liability is, which will then help you if you're about to make another trade on whether you need to make a loss or a gain on that next trade. We also show you your total taxable income for the year that you've derived from owning stock. So things like dividends, distributions, or crypto staking income as well. Now, if we drill down into the capital gains tax report, here you can see for this financial year, we give you a nice breakdown of how the exact capital gain or loss is calculated. And underneath are all the different records for how those gains were calculated. So these are the important records to be keeping if the ATO then audits you in the future. These will be the records you can produce to prove exactly how you arrived at those gains. You can also quickly change between tax strategies. So we were using minimize gain. You can change to FIFO, hit the button, and now everything's recalculated to FIFO. So it's as quick as that to do any calculation changes. Looking at taxable income, you can see for this year, we've aggregated all of your dividends and distributions together and broken it down into the particular tax codes that match up with the ATO My Tax form. Underneath all those tax codes is a nice summary of every single dividend and distribution you've received and the numbers for each one. And again, these are the numbers that you'll need to produce in the future if you ever need to back up the numbers that you've filed on your tax return. One more important report I want to show you is the unrealized gains report. This report simulates if you sold everything today, what would your tax liability be? And that means if you were about to make a trade, you could come and see, okay, if I sold some of my BHP positions, this is what my capital gain is going to be. And this allows you to make tax efficient choices before you make the trade, rather than making a trade, hoping for the best, and at the end of financial year, realize you owe a lot of tax. So Navexa is free to try for 14 days. Go to navexa.io and sign up for a free trial today and check it out for yourself. So we've made it to the end. You should now have a really solid understanding of how investment taxes work in Australia. Remember, tax is a huge part of the investing process. Firstly, because it's a legal requirement. And secondly, when you understand how tax works, you can make much smarter investment decisions. You'll avoid these situations where you sell something that you shouldn't have and you end up paying a lot more tax, when if you'd factored in tax prior to trading, you could have made a much more tax efficient trade. The most common mistake people do here is selling shares that they've owned for less than 12 months and end up missing out on that 50% discount for their capital gain. A good working knowledge of investment tax means you'll end up keeping your hard-earned returns for yourself instead of making poor decisions and end up paying needless tax. If you enjoyed this video or got something out of it, please make sure you like it and subscribe to our channel for more content like this. Drop a comment below with any questions that you might have. We'll see you in the next video.